So here is a sobering market stat for you as we get ready to close out what has been a very busy week. A whopping 58% of revenues from the U.S. tech sector comes from outside the United States. That now makes tech very vulnerable to a trade war, as we've seen these past couple of months. The rest of the S&P 500 getting just 39% of its revenue from outside of the country.
Well, as Andrew said, it's been a roller coaster week on Wall Street. After a series of stomach-turning drops, the S&P and NASDAQ actually turned positive for the week in yesterday's session. But our next guest says we are still in for a bumpy ride ahead. Joining us now, Sebastien Page, head of global multi-asset at Rowe Price. He leads a team that manages more than $330 billion. Sebastien, thanks so much for joining us this morning.
Thank you.
You say you don't want to be a hero by being tactical in this market. What exactly do you mean by that, and what should you be doing?
Yeah, now's not the time to be a hero. We're in for a bumpy ride, as you said. We have major market forces colliding. There is lots to worry about. Of course, trade uncertainty around Fed policy, but also slowing global growth, slower earnings, and generally speaking, a wall of worry that the market has to climb. On the other hand, though, global central banks have entered a significant and aggressive easing cycle. You have good employment data in the U.S. You don't have a lot of inflation. So those forces are colliding. And now's not the time to be a hero. We're not taking large tactical positions. We've just reduced our stocks allocation on the margin.
Sebastien, question for you. So if we are in an environment where we've got global easing across the board, putting downward pressure on interest rates, what do you think about equities just as the opportunity for kind of safe, high dividend yield? I mean, if you look at the S&P 500 right now, you know, over half of the stocks pay a dividend that's higher than the 10-year. Just curious your views on within equities, if that's where you're gravitating towards.
You know, that's an important question. And when you look, generally speaking, whether it's high dividend stocks or various sectors, growth versus value, utilities, you see this issue where stocks or sectors that are cheap have poor fundamentals, and stocks that have good fundamentals, like big growers, large cash flow generating tech companies, are very expensive. So this happens a lot in markets, but those spreads are pretty extreme right now, whether it's for dividend-paying stocks or for growth versus value, or if you look at small versus large caps. Some of the valuation spreads are worrisome. Growth versus value, for example, is in its growth is in its 98th, 99th percentile relative to the last 10 years versus value.
So what do you do?
So at the moment, we've reduced our overall stock allocation, and we're playing offense in a few parts of the portfolio. Relative to growth versus value, we have a small overweight to growth because ultimately we're late in the cycle, and those companies, we don't want to hold too many cyclicals when you're that late in the cycle. But other places where we play offense while reducing risk at the top level would be emerging markets equities. They're down 14% year to date relative to U.S. equities. We allocate as asset allocators to actively managed strategies. Portfolio managers in emerging markets equities have opportunities to look at countries, sectors, securities that have been dragged down with the asset class around trade worries, but that aren't necessarily linked to trade. So this creates buying opportunities in emerging markets, which is cheap to begin with, but we'd recommend doing it actively and actively managed strategies. We're also looking at high yield. On the margin, high yield has lower downside, we think, versus stocks at the moment. Spreads have widened. Default rates have remained stable. So we think that's an opportunity to add back some of the equity risk indirectly in the portfolio while we've reduced the stocks allocation at the top level. We've also added a little bit to cash as dry powder. The bumpy ride will provide opportunities to deploy capital quickly.
In terms of growth, what's the complexion of your growth allocation in terms of sectors?
So the growth allocation is mainly towards large tech growers, disruptors. We've bought into the thesis of disruptive companies for many years. So that's where some of the portfolio managers are concentrating their positions.
All right. Sebastien, we're going to leave it there. Thanks so much for joining us. We do appreciate it.